Hi there, I am Suk Day. Questions on step acquisitions of a company is often tested in final professional accountancy examinations. This tutorial is a continuation from my earlier tutorial on accounting for equity investments and joint operations in group financial statements. The purpose of this tutorial is to explain the accounting for step acquisitions as well as accounting for changes in ownership without loss of control in a target company. A step acquisition refers to obtaining a controlling interest in a target company through two or more separate transactions. Control is usually achieved when the parent company acquires more than 50% of the target company's share capital. What is tested in examination is the scenario where a parent company has a non-controlling shareholding in a target company and then acquires an additional shareholding to give it control of the target company. For example, Company A acquires 30% of Company B on 1st of January 2001 and then a further 40% on 1st of January 2002, resulting in a controlling shareholding of 70%. So, what are the accounting requirements for step acquisitions in consolidated financial statements? First, there is a deemed disposal of the original shareholding in the target company on the date the parent company obtains control by the acquisition of additional shares in the target company. 2. The gain or loss on the deemed disposal is the difference between the carrying value of the original shareholding on the date of control and its fair value. This gain or loss is transferred to the consolidated profit and loss account. Note, the carrying value of the original shareholding could have been accounted for in the consolidated financial statements under equity method, which is reserved for associates and joint ventures, or as a financial instrument under IFRS 9. IFRS 3 requires that all business combinations be accounted for by applying the acquisition method. The first step in acquisition accounting is to prepare a goodwill account on the date of control of the target company and will include the fair value of the original shareholding. In the next slide, we'll have a quick review of the entries in the goodwill account, as questions on step acquisitions provide you with the fair value of the original shareholding. Let's look at the entries in the goodwill account. The first entry is the fair value of the original shareholding before the date of control. The second entry is the purchase consideration for the additional shares or whatever and any other payments to get control of the company. And then you add the non-controlling interest. The non-controlling interest is the percentage shareholding not owned by the parent company in the target company or in the subsidiary. If the parent company owns 80% of the subsidiary, the NCI's shareholding is 20%. The percentage of the shares held by the NCI can be measured at either the fair value of the shares or at the NCI's percentage share of the subsidiary's identifiable fair value of the net assets. So, in a subsidiary which has an NCI of 20%, and you're going to use the proportionate of the net assets method, the value of the NCI will be 20% of the net assets. The choice of measurement is made on an acquisition by acquisition basis. Let's go back to the goodwill account. This gives us the total of the fair value of the acquirees as a whole, and from that we take away the book value of the net assets at the date of control plus any fair value adjustments, and the difference between the two gives us goodwill. If the fair value of the acquirees exceed the fair value of the net assets, then it's goodwill, and it goes as an asset in a consolidated balance sheet. If the fair value of the acquirees is less than the fair value of the net assets, it's regarded as a bargain purchase, and it's shown as a gain in the consolidated profit and loss account. In the next slide, we will look at the worked example of step acquisition. Let's look at example 1. XYZ PLC has a 35% investment in ABC PLC and is accounted for as an associate in accordance with IAS 28. XYZ PLC purchases an additional 40% interest in ABC PLC for $60 million cash. The fair value of the previously held equity interest was $45 million. The fair value of the net assets at ABC PLC at the date of control was $120 million under IFRS 3. So required, assuming that NCI, which is non-controlling interest, is accounted for using the proportionate share of the net assets method, prepare the consolidating entries. So the consolidating entries are the profit or loss on the deemed disposal of the original shareholding of 35% and the amount of goodwill at the date of control. Let's look at the deemed disposal, which is workings 1. Of the 35% of the original holding in ABC PLC on the date of control. So we have the fair value, which I think is $45 million, and the original holding was worth $35 million to give us a £10 million profit. And this amount will go to XYZ PLC's consolidated profit and loss account. The second working is to calculate the amount of goodwill. So we open up a goodwill account and start off with the fair value of the original shareholding, which was $45 million. We then work out add in the purchase consideration paid for the additional shares and control, which we are told is $60 million. And then we've got to work out the value or the value of the non-controlling interest. To work that one out, we've got to first work out what the NCI percentage is. So assuming that the original interest was 35% and XYZ acquired another 40%, we take that away from 100%, that gives us an NCI percentage of 25%. As we are using the proportionate share of the net assets method, we calculate 25% of $120 million, which is the value of the net assets at the date of control, and we get $30 million. We then add up all the fair value of the acquirees as a whole, and that gives us $135 million. We take away from that the fair value of the net assets, which were given as $120 million, and we take one away from the other, and we get a goodwill amount for $15 million. This amount will go to the XYZ consolidated balance sheet. Example 2 is another example of step acquisition. Alpha has a 40% shareholding in Beta, which was purchased several years ago at a cost of 10 million. This investment gave Alpha significant influence in Beta. On 1st of July 2020, Alpha acquired an additional 3 million shares, equivalent to 30% shareholding. The purchase consideration was in two parts, 3 million in cash and 1-for-2 share exchange when the market price of £1 Alpha shares was £6 each. Between the two acquisition dates, Alpha's net asset had increased by 12 million. The carrying amount of the net assets of Beta on 1st of July 2020 was 35.741 million and were equal to the fair values except for land, which had a fair value of 600,000 above the carrying amount. The Alpha Group values non-controlling interest at fair value, and the share price of Beta at 1st of July 2020 was £3.80. This share price should also be used to value the NCI at that date and also to value the initial 40% equity interest in Beta. So what is required here is to explain how the initial 40% investment in Beta and the additional purchase of the equity shares on 1st of July 2020 should be accounted for in Alpha's consolidated financial statements. Right, the solution. Number one, the acquisition of Beta is a step acquisition. We have a non-controlling stake of 40% to a controlling stake of 70% in Beta on 1st of July 2020. The original 40% shareholding in Beta would be accounted for as an associate company in Alpha's consolidated financial statements until 30th of June 2020 using the equity method. As you can see from the example, Beta was, Alpha had a significant influence in Beta. On 1st of July 2020, there is a deemed disposal of the 40% shareholding in Beta when Alpha acquired control of Beta by acquiring 30% more shares. A goodwill account will be prepared on 1st of July 2020 on the date of control under acquisition accounting, and in the next slide we'll show the working for the gain or loss on the deemed disposal and the goodwill account. The first step is to calculate the carrying value of Beta shares at 30th of June 2020. We start with the original cost of the holding purchased many years ago at 10 million. In equity accounting, any increase in net assets from the date of acquisition is added on to the cost of holding. So we are told that between the two acquisition dates, Beta's net assets had increased by 12 million. So 40% times 12 million gives us 4.8 million. And that gives us a carrying value at 30th of June 2020 of 14.8 million. Our next step is to work out the gain or loss on deemed disposal on 1st of July when Alpha acquired 30% more shares or 3 million shares. So the fair value of the 40 million shares is worked out by looking at the value of that 40% shares on 1st of July 2020, and we are told to use the value of £3.80 per share at that date. So that gives us 15.2 million, and if we take one away from the other, we get a profit on deemed disposal, which is 400,000. As this amount will go to the Alpha's consolidated financial statements of 30th of June 2021. Our next step is to work out the balance of the goodwill account on 1st of July 2020 as Alpha acquired a controlling stake. So we start with the fair value of the original 4 million shares at £3.80, which is 15.2 million. We then add on to it the consideration for the additional 3 million shares acquired on 1st of July. The first was that there was a share exchange, and it was a 2-for-1 exchange. So 1.5 million shares of Alpha at £6 gives us 9 million. We add the cash consideration given of 3 million. Finally, there is the remaining non-controlling interest NCI of 3 million shares, and these are to be valued according to the question information given at £3.80 per share. So that gives us 11.4 million, and that gives us the fair value of all the acquirees, by that controlling and non-controlling shares, of 38.6 million. To work out the goodwill, we take away the fair value of the net assets, and we start with the fair value of the net assets given, which is 35.741. We're also told there was an increase in the fair value of the land of 600,000, and so if we again take away the difference, we have a goodwill balance of 2.259 million. So therefore, to answer the question, we have a profit on deemed disposals of £400,000 and a balance on the goodwill on 1st of July 2020 of 2.259 million. Right, next we look at how to account for changes in ownership in a subsidiary without loss of control. Let's look at the accounting requirements for changes in ownership without loss of control. Any subsequent transactions in a subsidiary's equity interest between the parent and non-controlling interests, both acquisitions and disposals that do not result in a loss of control, are accounted for as equity transactions in the parent company. Any difference between the non-controlling adjustments and consideration paid or received is recognized directly in equity attributable to the parent owners. There is no adjustment to the goodwill amount, as there are no remeasurements of net assets to fair value. Let's look at an example. Company A acquired 60% of Company B in 2016. The carrying value of the non-controlling interest on 1st of January 2021 was 1.13 million. On 1st of January 2021, Company A buys an additional 20% of Company B shares for 260,000 cash. So required, how should the above transaction be recorded in Company A's accounting records? Well, the solution, first, Company A already has control of Company B, so the additional purchase of B's equity will only affect the non-controlling interest and Company A's equity balances. Start off with the balance on 1st of January 2021. We're given for the 40% holding, which is 1.13 million. We disposed of 20%, which is equivalent to 20% times 1130, that gives us 226. And 1st of January, on same date, the new NCI balance, which is now reduced to 20%, is worth 904,000. The cash paid for 20% of B shares by A is £260,000, less the transfer from the non-controlling interest, which we worked out was 226,000, and therefore the amount debited to the parent's equity or components of equity is 34,000.